The three highs are strangling the U.S. economy, and stagflation is crashing the dollar's hegemony. High oil prices fuel inflation. High interest rates suppress the economy. The myth of U.S. debt collapses, and the credit of the U.S. dollar collapses. Stagflation rises, and the U.S. dollar is in danger. The U.S. dollar depreciates, and U.S. bonds are sold off. High oil prices, and high interest rates. The triple pressure locks the U.S. economy. The crisis caused by stagflation will deal a fatal blow to the U.S. dollar hegemony. Inflation is burning, interest rates do not drop. The economy will stop, and the U.S. dollar undergoes a wild depreciation domestically and collapses its credit externally. U.S. bonds keep growing larger, and the interest payments keep increasing. The myth of the U.S. dollar as a risk-free asset is being punctured. In the past, the U.S. dollar harvested the world through inflation. Now, inflation is retaliating against itself. In the past, high interest rates absorbed global capital. Now, high interest rates have crushed the U.S. economy. The Federal Reserve is in a dilemma. Raising interest rates will kill the economy. Lowering interest rates will cause inflation to explode. The world is voting with its feet, selling U.S. bonds, buying gold, and avoiding settlements in the U.S. dollar. Oil moves away from the U.S. dollar. Trade moves away from the U.S. dollar. Reserves moved away from the U.S. dollar. The foundation of the U.S. dollar is rapidly loosening. History has already proved that stagflation is the ultimate killer of a hegemonic currency. This time, the U.S. dollar will not escape either. The global de-dollarization is accelerating, and an era is coming to an end. The days of the dominance of the U.S. dollar are coming to an end. If the United States were to experience a prolonged period of stagflation, it would systematically undermine the dominance of the U.S. dollar from four dimensions: credit foundation, monetary function, financial hegemony, and international landscape. The impact would be long-term, structural, and irreversible. The core impact of stagflation on the dominance of the U.S. dollar. 1. Collapse of the credit foundation of the U.S. dollar. Internal depreciation plus external trust crisis. Internal purchasing power collapse. High oil prices pushed up inflation throughout the entire industry chain, combined with high prices, forming a price spiral. The value of the U.S. dollar rapidly shrank. During the stagflation period in the 1970s, the inflation rate in the United States once exceeded 13.5%, and the actual purchasing power of the U.S. dollar significantly declined. Sovereign credit damage. High interest rates significantly increase the interest expenses of the federal government. U.S. debt exceeds $35 trillion. Deteriorated fiscal deficits. The risk of downgrading the sovereign credit ratings of the United States rose and undermined the global belief in risk-free U.S. debt. Stagflation, depreciation, debt spiral, economic stagnation, plus high inflation gives market bears on the U.S. dollar gives. Capital selling off U.S. dollar assets gives. U.S. dollar depreciation gives imported goods become more expensive gives. Inflation further intensifies, forming a vicious cycle. 2. Weakening of the core functions of the U.S. dollar. Its roles in payment, reserve, and valuations have all declined, meaning the global payment share shrinks. High inflation and economic uncertainty have led to a reduction in the use of the U.S. dollar for global trade settlements, accelerating the development of local currency settlements and regional currency alliances, such as the euro, the renminbi, and the BRICS currencies. The proportion of U.S. dollar payments in the SWIFT system continues to decline. Foreign exchange reserve proportion drops. Central banks around the world are accelerating their de-dollarization, reducing their holdings of U.S. bonds and increasing their holdings of gold and other currencies. The proportion of the U.S. dollars in global foreign exchange reserves has decreased from 66% in 2015 to 57.4% in 2024. Stagflation will accelerate this trend. Counting rates for commodities are shaken under the impact of high oil prices. Commodities such as oil are seeking non-US dollar pricing, such as the RMB for oil settlements in euros, and the core pillar of the US dollar as the oil currency has been completely weakened. 3. Disintegration of the US dollar's financial hegemony. Loss of asset attractiveness plus global capital flight triple blow to US bonds and stocks. High interest rates suppress stock market valuations. High inflation erodes the actual returns on bonds. Stagflation will cause the US stock market, US bonds, and the US dollar to simultaneously plummet, and global capital will massively withdraw from US assets. Failure of monetary policy. The Federal Reserve is caught in a dilemma of fear of recession when raising interest rates and fear of inflation when lowering interest rates. With its policy space severely compressed and the ability of the US dollar to anchor interest rates globally has significantly weakened. Financial market turmoil. The US dollar exchange rate fluctuates sharply. The stability of global financial markets declines. The attribute of the US dollar as a safe haven currency is severely weakened, and funds shifted to other safe haven assets such as gold and commodities. For a reconstruction of the international monetary landscape, a diversified monetary system is accelerating its formation. Emergence of regional currencies. The international usage of non-US currencies such as the euro and the renminbi has expanded, and regional trade settlements and cross-border investment and financing are increasingly eyeing from the US dollar system. Global de-dollarization mechanism is improving. Countries are accelerating the construction of cross-border payment systems, independent of SWIFT, such as SIPs, instead, reducing reliance on the US dollar clearing system. Global economic multipolarization, the decline of US hegemony, and the weakening of the US economy. Power had driven the international monetary system to shift from one superpower dominance to diverse and balanced system. Are 2 historical lessons. How the stagflation of the 1970s seriously threatened the dominance of the US dollar. Collapse of the Bretton Woods system. In 1971, the US dollar was decoupled from gold, losing its anchor status, laying the groundwork for the collapse of the US dollar during the stagflation period. The third US dollar crisis, 1977-1979. The combination of 2 oil crises and stagflation led to a 30% depreciation of the US dollar against the German mark and the Japanese yen within 2 years. Global central banks frantically reduced their holdings of US dollars, and the credit of the US dollar was on the verge of collapse. Long-term consequences. Although the dominance of the US dollar did not immediately end after the stagflation, global trust in the US dollar permanently declined, sowing the seeds for the subsequent birth of the euro and the multipolar currency landscape. As 3. The special nature of this impact of stagflation round, more severe than in the 1970s. Larger debt scale. Currently, the debt-to-GDP ratio in the United States exceeds 120%, much higher than in the 1970s. Under high interest rates, the burden of debt interest is heavier, and fiscal sustainability is worse. The buffer provided by shale oil has vanished. In the 1970s, the United States was a net importer of oil. Now, although it is a net exporter, the shale oil production cycle is long and high quality. Well, sites have been exhausted. The drag effect of high oil prices on the economy is more difficult to offset. Global de-dollarization has become a trend. After the 1970s, the US dollar was still able to rebuild its hegemony by virtue of military and technological advantages. However, currently, global multipolarity is accelerating, and non-US currencies and payment systems have the ability to replace the US dollar. The difficulty of restoring the US dollar's hegemony is extremely high, for a stagflation is the ultimate test of the US dollar hegemony. The United States falls into triple high stagflation. It will be a systemic and fatal blow to the hegemony of the US dollar. In the short term, the US dollar index will plummet, US bonds will be sold off, and global financial markets will experience severe turbulence. In the medium term, the share of the US dollar in payments and reserves will accelerate its decline, and the pricing power of commodities will weaken. In the long term, the irreversible damage to the credit foundation of the US dollar will occur. The process of diversifying the the monetary system will accelerate significantly, and the hegemony of the US dollar will shift from absolute dominance to relative dominance, gradually being replaced by a multi-currency system.